All right. Welcome, everyone. Thanks for joining us again on the Salem Central event. We are happy to have with us today Joshua Rauh from Stanford University, where he's a professor of finance. He's also a senior fellow at the Hoover Institution and also the co-founder and co-director of the Global Liberty Institute. Maybe he tell us a little bit about that as we go here. Josh is an expert on taxation and government regulation and its effects on the economy, has written lots of papers, lots of different areas, and today joins us to talk about investing for society. I guess it's his take on the ESG movement and the whole stakeholder capitalism discussion that's been taking place in the last few years. Josh, thanks for joining us. Welcome everybody, I guess, to the room, and take it away.
Thank you, Carlos. Well, thanks for the invitation. And the talk I'm giving today is called Investing for Society, Why We Should Preserve Shareholder Capitalism and How to Do It. And as Carlos mentioned, I'm a finance professor at Stanford GSB. I'm also a senior fellow at the Hoover Institution, and I'm the co-founder with Dr. Scott Atlas of a new institution called the Global Liberty Institute, where we aim to provide programming and rising leaders programs that stand behind the principles of freedom and liberty, and I encourage you to check that out. So, investing for society. Okay, so what does that mean? Well, I'm going to go back to the very, very beginning. Sort of the very beginning, which is Milton Friedman, in order to address the question, what is shareholder capitalism? You hear about these two models of capitalism, shareholder capitalism versus the stakeholder model. What is the shareholder model of capitalism? Well, it's often pointed to that Milton Friedman wrote an op-ed in the New York Times in 1970, very long ago. And the title that the editors put on this, I believe it was the editors who put the title on the op-ed, that's usually how it works as opposed to the actual author of the op-ed, was A Friedman Doctrine, the social responsibility of business is to increase its profits. So that's a very direct title, right? It's unambiguous what that title is saying. What's interesting, though, is that the actual content of the article is a little bit different from what's actually in the title of the article. So, and in particular, if you read the article, it puts forth a view that says the following. It says that the corporate executive's responsibility is to conduct the business in accordance with the owner's desires, which generally will be to make as much money as possible while conforming to the basic rules of society, both those embodied in law and those embodied in ethical custom. So there are a few interesting points about this statement, one of the main statements in the article, that aren't necessarily captured by the title of the article. One of the points that this statement makes that is not captured by the title of the article is that it actually doesn't say that the responsibility of the business is to maximize profits. It says the responsibility is to conduct the business in accordance with the owner's desires, which generally will be to make as much money as possible, but also not without some conditions, right? While conforming to the basic rules of society, both those embodied in law and those embodied in ethical custom. So Milton Friedman was not saying that anybody should break the law to maximize shareholder value. Milton Friedman was also not saying that anybody should do anything that's unethical in order to maximize shareholder value. But he was saying that the corporate executive's role is to operate the business in the way that is conducive and most in accordance with the owner's desires. And this goes into further detail. He actually writes, he says, in some cases, the employers may have a different objective. A group of persons might establish a corporation for an eleemosynary purpose. That's a fancy word with an ancient Greek background. Richard, I know you share my love of classics, so you know exactly what this means. For example, a hospital or school, so eleemosynary means for charitable purpose. And the manager of such a company, such a corporation, Milton Friedman writes, will not have money profit as his objective, but the rendering of certain services. In either case, he goes on, the key point is that in his capacity as a corporate executive, the manager is the agent of the individuals who own the corporation or establish the eleemosynary institution, and his primary responsibility is to them. So the Milton Friedman model of shareholder capitalism, regardless of what the title of the New York Times op-ed says, and again, I'm starting with the assumption that the editors of the newspaper write the titles, because that's been my experience. You hand in the op-ed, you think it's all ready to go, the editors slap a title on you think, is that what I really meant? So I wonder, I don't know for sure that he had that feeling or not, but if you read the article and you read the title, they're actually saying quite different things. And the article says that the responsibility of the executive is to do what the owners want. And in this talk, I'm going to use the term owners and shareholders synonymously. I learned in a recent congressional hearing that not everybody views the term owner and shareholder as being sort of equivalent, right? But from my perspective, the shareholders of the company are the owners of the company. And so according to the Milton Friedman shareholder view, the responsibility of the company is to do what the owners of the company, what the shareholders want, regardless of what it might be, right? That might involve an element of machinery stuff, charity, but it might also be to maximize shareholder value. So, and the shareholder model is still the law of the land in the United States. And on what basis do I say that? Well, this gentleman, this is Leo Strine Jr., okay, Chief Justice of the Delaware Supreme Court, and actually one of the main advocates of introducing a new legal philosophy to capitalism. He wants to introduce a stakeholder model to capitalism, one that does not only focus on shareholder value. But despite his desire to do that, he admits that the law of the land is actually the shareholder model. So there's this long quote here, you don't have to read the whole thing. The bottom line is the part in bold where he says the only way to make the world be more like what it ought to be, in his conception of what the world ought to be, one where we consider all stakeholders, that's his view, is to be willing to be clear-eyed about what it is, which is a shareholder value maximization place, right? So that's even the proponents, the most sort of intelligent and well-regarded proponents of the stakeholder model, are pointing out that the law of the land is still actually the shareholder model. Now you might think to yourself, okay, well that sounds terrible, right? If you're thinking from the perspective of society, well, boy, does that mean that managers always have to just constantly, heartlessly maximize shareholder value? How horrible! Well, turns out that actually there's a lot of leeway that managers have to make decisions that they argue are motivated by a bona fide regard for the interests of shareholders. Essentially, it allows the managers of the company to say, you know what I'm doing, even though I say I was doing this ESG stuff, even though what I was doing was not specifically motivated maybe by an immediate maximization of shareholder value, actually I'm going to argue that it is, that in fact what I'm doing is in the interest, the long-term value creation interest of the company, and managers have got wide latitude to make that claim. So in any lawsuit against managers, the lawsuit has to show that they breached fiduciary duty. So that means they either displayed bad faith, or they breached the duty of loyalty, or they breached the duty of good care. And that's a really, really high standard. So even though shareholder value maximization is still the law of the land, it's actually very, very hard right now to sue a company if you're a shareholder and say, yeah, you know what, you did this thing that was not consistent with maximizing shareholder value. For example, maybe you did something to reduce carbon emissions. It cost the company money, but you're claiming it's good for society. We're going to sue you because you're not maximizing shareholder value. Actually, it's very, very hard to sue management under those types of claims because of what is called the business judgment rule. This collection of cases actually goes back to 1919. That courts are not going to intervene unless management can be shown that they're guilty of fraud or misappropriation. And there have been recent calls to revisit the business judgment rule. So in particular, some of you may know the work of Vivek Ramaswamy, who wrote a book called Woke Inc. And one of Vivek Ramaswamy's many points is he argues that the business judgment rule actually has to be amended and reformed. And the basis on which he's arguing that is he's saying there isn't enough accountability to shareholders. There isn't enough opportunity for shareholders to say, you know what, no, you managers did not do what I wanted you to do. And so that's one of the debates that we're having today. Who are the shareholders? So often in the whole shareholder view, it can be sort of forgotten, this amorphous group of shareholders. Who are shareholders? Well, this graph shows holders of the U.S. equity market. And you'll see that 37% of the U.S. equity market is owned by households. The next largest group is 22.5% is owned by mutual funds. And most of those mutual funds are actually, in turn, owned by households. The next group is foreign investors, 15%. Then we're going down to the next bar. Those are exchange-traded funds. That's around 6%. And then we're getting into some institutional money, state and local government pensions, private pensions, non-financial corporations, then much less life insurance, federal government pensions, other. Why do I put this slide up? A lot of times when people talk about shareholders, there's this view of some kind of incredibly rich institution, right? Some kind of huge fund that is not owned by a household, but that's just basically, some corporate entity that owns massive amounts of money. That's actually not what's going on. Most equity in the United States is owned, at least indirectly, by households. So households are, directly the owners of the plurality of the stock market. And through mutual funds and ETFs, mostly households, they're owning, a majority of the stock market. These other categories, state and local government pension funds, these are also in some ways, the beneficiaries of those are, of course, rank and file public employees, private pensions, same thing. So when we talk about shareholders, we're actually really talking about ourselves. Shareholders are, they are households. They're not just these kind of amorphous institutions. And of course, while shareholding is concentrated among higher income people, what percentage of households actually own stock directly or indirectly? Well, it's over half. Okay, so over half of households own some stock holdings. And so when you say, we're going to do something that doesn't maximize shareholder value, you actually have to think that you're going to be, you got to be responsible to all of these families, all of these people. Whether, sure, Bill Gates and Jeff Bezos own more stock than I do, but nonetheless, I am still, and anybody else here who owns shares, you're an owner in companies, and if we're following the shareholder model of capitalism, the managers need to be thinking about what it is that you want, because you are the owners, what we call a principal agent problem, right? You are the principal because you own the shares, and the managers of the money are the agents. So over 50% of U.S. households actually own stocks. So what are the criticisms of the shareholder theory? I'm going to go through a few of these criticisms. I'm going to then introduce the stakeholder theory, and I'm going to try to talk about when these things are consistent and when they're in conflict. And I'm going to kind of conclude by arguing that what we really need to do actually is to preserve the shareholder model, because the shareholder model is the only one that actually respects the basic concept of property rights. As somebody, owner of stock, the managers of that company have got to, in a principal agent setting, have got to actually be serving the interests of the owners of their principals. So, okay, but what are the criticisms of the shareholder theory? So, first big criticism is you hear often the claim that shareholder-dominated companies maybe focus on short-term stock price rather than long-term value. I hear that claim a lot, so I'm going to critically assess that in a second. Second main criticism is under the current framework, shareholders might be free to engage in activities which harm other stakeholders. So, for example, maybe a company can do things that are harmful to their workers, but that increase shareholder value, or harmful to the environment, but that increase shareholder value. So, I'm going to take these two things in turn. Okay, so first, let's talk about the short-termism critique of shareholder theory. So seems like there we go. I think it's back. I can see the slides.
Yeah, me too.
Okay, great. So the first critique is short-termism. So what this graph shows is there are two graphs, and they show two things. One is research and development expenditures, and the other one is around the time of IPOs, whether the firms were profitable or not. So on the left, median R&D to assets during the past 12 months when R&D is non-zero. And what you can see here is that in the United States, 25%, companies are spending 25% of assets on research and development expenditures each year. Right graph shows percentage of IPOs with an earnings loss during the past 12 months. Almost two-thirds of IPOs in the United States had an earnings loss in the previous 12 months. And this is similar in other countries, other contexts. So the evidence, and now I actually can't go forward. Okay. So the short-termism hypothesis is that decisions that incur long-term costs might not be reflected in current stock prices, and that would mean that the market participants are not properly valuing expected future cash flows. But the evidence, though, this is some pretty big evidence that is not consistent with that fact, right? So I'm sorry, once again, I'm still unable to advance the slide, we're stuck. But the evidence shows this is not exactly consistent with super short-term shareholders. If companies are investing 25% of their assets, of the value of their assets each year in R&D, and the stock market still has, trillions and trillions of dollars worth of value, it's kind of hard to imagine that the market is so short-term that they're not willing or able to accept the idea that that managers could be doing things that have very, very long-term payoffs. And then on the other piece of evidence, the IPOs, most companies that go IPO, that sell their shares to the public for the first time, have experienced substantial investment losses over the prior year. So let me give some examples. Now it's working. Let me give some examples. Okay, so here's Dropbox. Okay, so Dropbox was losing 31 cents per share in the year before the IPO, and buyers in that IPO were willing to pay $21 per share. They said, company's losing money, losing 30 cents per share, no problem, I'll pay 21 bucks per share. How short term can they really have been thinking? Next example.
Well, just click on the.
Just click on what?
I think you need to get on the. There's two desktops. You need to be on the page where the slides are. If you click there, and you have your cursor there, then they work.
Do exactly what you did and just click on the slide.
Yeah, do exactly what you did before. Yeah, that. Now just click on the slide. That's it. That's it. There we go.
Okay.
That's it.
Okay, so next example, this is Robinhood. The company was losing $2.59 per share. The market said, I'll pay $38 per share for that earnings, for companies losing. And of course, the only reason they were doing this is because they thought that there was a future time, could have been a very long time, but at some future time, they believed that the company is going to be profitable. Yeah.
Couldn't they also be responding to Federal Reserve currency manipulation?
Well, that's an interesting idea, but let's postpone some of that until a little bit later in the talk. Next, here's Spotify. Okay, Spotify losing $5.29 per share. Market says, I'll pay $132 for each $5.29 loss. Okay, and then here's Airbnb, right? Losing $12.59 per share, no problem. 146 bucks a share. That's what I'm willing to pay for that company that's losing $12.59 per share. So how much short-termism can there really be in these markets? Okay, so to me, the criticism that shareholder-dominated companies must be focusing on some short-term stock price rather than long-term value, not really convincing. The second point, under the current framework, shareholders are. Yeah.
What evidence do proponents of that use?
I think they'll typically give views like they'll say it often gets very wrapped up in the second one, right? Because I think that they're saying things like a private equity company took over a firm, fired a bunch of workers, and then the firm went public again. And now, again, I think that's more number two, which is they did something that might have increased shareholder value was bad for workers. But they might make the claim that, in the long run, this release of workers is going to be value destroying because. Yeah, so that's right. So they point to that and they say that in the long run, they argue in the long run the company would be more valuable if they hadn't broken it up. But I think there's not really much evidence for that, right? Because we don't really know what the counterfactual is. Another example they'll give, and I'm going to talk about the slides, they'll say, well, things that might be bad for the environment. They're saying in the long run, it's going to be the case that doing bad things to the environment it's going to come back to bite the company. It's going to hurt shareholder value because the company is going to get slammed because the environment's going to be worse, and that's going to hurt the company's profits in various ways. Or there's a kind of circular argument, which is, if you do bad things for the environment, the government's going to come and regulate you, and so therefore you're destroying shareholder value. So there's that comes in there. But most of these come under really sort of the second, which is that you're doing something for one group of stakeholders in order to promote shareholder value. Yeah.
There's a literature on short-term shareholder versus long-term. I don't really know what you're
Yeah. So actually, I've even written a paper about this. Earnings management. The idea that in accounting, that companies can shift earning, use accounting tools, I don't want to say tricks, but the accounting rules to shift earnings around over time. And if they shift earnings up forward and the market is really focused on, price earnings ratios, they're just kind of blindly slapping PE ratios on the company. Then if you shift earnings from the future to the present, you might be able to get a short stock price bump. You might then be able to sell your shares. And then in the future, this thing's going to unwind. Those things seem to be possible, and they happen, but the magnitude of these just seems to be not that big. Again, when you have this kind of thing going on, it just seems like the basic idea that markets don't pay attention to things that might create a lot of long-term value just seems to be not consistent with the basic facts. So I want to talk about the other point, and the idea that there's going to be this there's these trade-offs that are going on, right? You hurt one group of stakeholders in order to help shareholders, and this has been put forward very much in the stakeholder model of capitalism. The stakeholder model of capitalism, I think, probably is best encapsulated in this Business Roundtable statement from 2019, which you might have heard about, the statement on the purpose of a corporation. So the Business Roundtable, which rather remarkably is actually a group of CEOs of companies, came forward with a statement that said that Americans deserve an economy that allows each person to succeed, and we're going to actually say that we commit to the following things. We commit to delivering value to our customers, investing in our employees, dealing fairly and ethically with our suppliers, supporting the communities in which we work, generating long-term value for shareholders who provide the capital that allows companies to invest, grow, and innovate. So this Business Roundtable statement named sort of 5 objectives, and shareholder value maximization is sort of number 5 here, right? They're saying we're doing these other things. We're going to deliver value to customers. We're going to invest in our employees. We're going to deal fairly and ethically with our suppliers. We're going to support the communities in which we work, including, we respect people, communities, protect the environment, embrace sustainable practices, and so on. So they came up with this statement. Now, I say kind of remarkably, it's the CEOs. Why do I say it's remarkable? Well, who are the CEOs? I mean, the CEOs are actually employees of the owners of the firm. They're employees of the shareholders of the firm. The shareholders have, appointed a board, and that board has then, in this kind of chain of principal agent problems, that board has then selected a CEO, and that CEO now is, through that chain, they're actually responsible to the owners of the company, to the shareholders, and yet they're coming out with a statement that says we're responsible to all these other people. I testified in a congressional committee about this topic, and I did a little research on who's on the committee, and I noticed that one of the people on the committee was the founder of a well-known store, a retail chain of wine stores, And I know that this person is a major proponent of stakeholder capitalism. If they gave me too hard a time, I was going to say, look, how would you feel? You're here in Congress, you've appointed a CEO to manage your wine store. Now, how would you feel if the person managing your wine store is telling you right now that they're just giving away wine to whatever customer walks in the door? Because after all, they're interested in the well-being of the customers, not shareholder value. Not here. So I was ready with that, but fortunately, we didn't have to go there. But it's a little bit like that because the CEO is actually the person who is appointed by the owners of the company to do what the owners of the company want them to do. And again, even in the Milton Friedman model, perfectly fine for the owners of the company to want something other than shareholder value maximization. That's okay. But at the end of the day, it's up to the CEO. The CEO's job, the reason that the shareholders are hiring the CEO, is to do what the shareholders want them to do. So it's really sort of remarkable that the CEOs are the ones saying, you know what, we're actually not going to be only responsible to shareholders. We're going to be responsible to all of these other stakeholders. Now, there are a few sort of kind of ways around this contradiction, right? So one way around the contradiction is to say, well, come on, if you don't deliver value to your customers, how long are you going to be in business, right? Delivering value to customers must be consistent with creating long-term shareholder value. Or, investing in your employees, right? If you don't invest in employees, you're not going to have skilled employees. They're not going to be able to do what's needed for the company to run. Similarly, like dealing ethically with our suppliers. I mean, if your suppliers feel like you're not dealing ethically with them, then they're not going to do business with you. You're going to have to find other suppliers. So there's some way in which one thinks that many of these principles are actually consistent with long-term shareholder value, and that is actually the view that's put forward by the largest money managers in the country, people like Larry Fink, who actually have espoused these ideas of stakeholder capitalism. Here's a quote from Larry Fink. He says, "In today's globally interconnected world, a company must create value for and be valued by its full range of stakeholders in order to deliver long-term value for shareholders. It's through effective stakeholder capitalism," he says, "the capital is efficiently allocated, companies achieve durable profitability, and value is created and sustained over the long term." So in other words, he claims there is no conflict between the shareholder model and the stakeholder model. These two things are 100% in agreement. Well, I don't know. I'm not so convinced that they're in agreement. I think it would be really nice for the marketing of the investment strategies that his firm is taking on if it were the case. But I think that the evidence suggests that there are going to be trade-offs. And actually, if you just start out with just kind of basic investment theory, there really sort of have to be trade-offs. One type of socially responsible investing involves negative screening, meaning you don't invest in companies that are that get bad ESG ratings or are doing certain things that you think might be harming other stakeholders or harming the environment. Well, if you just think back to basic finance, there's that capital asset pricing model and that efficient frontier, and there are all those little assets in the efficient frontier. And if you take any assets away from the middle of that, take dots away from that graph, your efficient frontier is going to shift. You're not going to be able to get the same. You're not going to be able to get the same expected return without taking more risk. Or put another way, if you're targeting given level of risk, you're going to have a lower expected return. So just kind of basic finance theory suggests there's going to be some kind of conflict. Again, unless you sort of believe in some kind of short-termism type of thing, maybe you can try to line these things up. But certainly there are going to be situations where shareholder value maximization and stakeholder considerations are in conflict. And this investment strategy, ESG, environmental, social, and governance investing, has obviously been seen one of the biggest increases in sort of investment philosophy, AUM, that we've seen for forever, probably in the history of investing. $24 trillion in so-called sustainable assets, most of which is in ESG, right? So there are kind of three categories that this sustainability report has highlighted, and one of them is sort of traditional corporate governance, which is really the kind of shareholder value maximization. That's this tiny sliver that was most of what was going on in the 90s, but then the vast majority of what we've seen this increase has been in ESG integration, and so we've seen this huge increase, and it's everywhere. It's in retirement funds. So I like to look at 401k plans, right? These are plans that any investor, any kind of individual who's got a retirement plan for their company in the private sector has got a 401k plan. They're increasingly, ESG is increasingly represented in these funds. So 18.2% of funds offer a sustainable, so-called sustainable fund as of March 2022. And when you survey respondents, survey 401k plan participants, and you actually, there are two surveys. One survey surveys the plan sponsors, the other surveys the participants. The sponsors are increasingly offering these ESG options. 40% of those who are not offering, is what the graph on the right shows, are considering offering one. And here's something that's really remarkable. Schroders U.S. Retirement Survey, the majority of defined contribution plan participants, so these are the individuals, these are just the workers in these plans, right? So, everybody who works in the private sector who's got a retirement plan these days, unless they're working for a really old line company, they have a DB plan. Just about everybody you know, that's the universe of DC participants, 401k plan participants. 78% said that they believe that companies that are ESG focused will have better results. So those are the beliefs under which people are operating when they're choosing funds. And that's where I think some of the problem comes in, because how do we know that this is so, right? It seems like there are many types of investing for society that could very well lead to lower shareholder returns. Might be good for some other stakeholders, but the fact that the majority of the participants basically believe what Larry Fink said. They believe that companies that are ESG focused will have better results. Unfortunately, we can look at some results, and that's what I'm going to do next. Okay, so I'm going to look at some of the criticisms of ESG investing, and there are three main criticisms. One is that the definition of ESG is inconsistent and opaque. So I'll talk about that for a moment. The second is that these claims of financial materiality, the idea that ESG is always correlated with better financial performance, that claim is overstated. And then the third problem is accountability. Is it what owners actually want, right? This survey here suggests that, well, okay, there's some non-trivial amount of people who may want ESG investing. They may want it under a sort of false premise, under the idea that companies that are ESG focused will have better results. There are some people who want it, but there are also people out there maybe who don't want it, or who want it for reasons that aren't actually well founded. If they were brought up to speed on what that was actually going on, they might not want this type of investment philosophy. So point number one, inconsistency and opacity in ESG. I mean, even the insiders who have come out have often told tales and explained things like this. In many cases, it's cheaper and easier to market yourself as green rather than do the long tail work of actually improving your sustainability profile. So this is from the former chief investment officer at BlackRock. And the data and the studies support this. So a few points. First of all, if you look at ESG ratings across different firms, there are firms out there that are responsible for rating the ESG quality, the environmental, social, and governance quality of different firms. Not very highly correlated across those rating agencies. When you compare credit ratings, for example, rating agencies' ratings of firms, of their credit quality, very, very highly correlated. Comparing ESG ratings, not so much. Second point is that ESG ratings firms, it's very inconsistent. It used to be that investing in weapons manufacturers is definitely not ESG, but ratings firms have been reconsidering punishing weapons manufacturers, giving them bad ESG ratings, because after all, now there's a war in Ukraine and we need weapons. Let me just get through the talk, and then I'll take some more questions. And then third, ESG ratings are subjective. I mean, the ability to discern the degree to which a firm carries out ESG practices is defined by the rating agency is not obvious. What these graphs are from a study by a group at MIT that named themselves the Aggregate Confusion Project, which I thought was interesting because it sort of reveals what they thought of ESG, that is creating aggregate confusion. But in any case, what the graphs show is, all of these ESG ratings companies, they all claim to take into account, 40, 50, 60 different inputs into these ESG calculations. How ESG friendly is a given company? And what this shows is that for a lot of them, particularly, I guess, B and C, D and E, so that's S&P, Moody's, or Fink Sustainalytics, really sort of 50 out of the 60 aren't really adding any value at all. It's really only a few things that they're actually rating the firms on. And then also that, different companies are just doing different things. I mean, there's some of these KLD and the CI, they are actually rating on 50 different things, and each one of those is adding some informational content. So really inconsistent across firms, hard to know exactly what ESG even means. Opacity, right? If you ask investment firms, this is a CFA Institute poll of investment firms, why are you doing more non-financial consideration in your investment decisions? They're citing a lot of different concerns. They're concerned about transparency. They're concerned about comparability. They're concerned about disclosure. They're concerned about materiality. All of these different points. Number one is lack of appropriate quantitative ESG information, lack of comparability across firms, and so on. And this really, I guess you'd say, this sharpens the debate about what regulators should do. So some people look at this, and this is what I kind of tend towards. I look at this and I say, you know what, this entire thing actually seems to be sort of a fool's errand. I mean, everybody's defining ESG in a different way. The whole idea seems to be kind of pointless. If shareholders want companies to disclose certain things, they can ask them to disclose certain things. And if enough shareholders want those disclosures will happen. If not, then no. Other people look at this and they say, well, we need the SEC to come in and dictate a set of ESG disclosures that firms should make. And that's the group that's kind of currently in power at the SEC. And I'm not sure that that's going to bring us to a good place, because that's going to be the government saying, the government's going to say, here are the criteria that everybody should use and things that everyone should disclose. And that's going to be really the government actually kind of shifting what they're saying people should care about in their investments. Some other evidence, right? So here, this is from a meta-analysis, not by me, but by a set of authors of over 1,100 ESG performance studies. Ouch. They combed through 1,100 studies to see if they could disentangle whether ESG is correlated with better or worse stock market performance. Now, one thing that I will note is that flows could affect performance. So ESG being one of the most trendy finance ideas over the last 10 years could itself have brought in a lot of capital, which then could have driven up market returns over the short run, even if ESG isn't good for long-term value maximization. What this group of authors did is they looked at over 1,100 companies and 1,100 studies rather, and they found a very, very wide range of different results in these studies. So now, there are two different types of studies. One are corporate studies focused on corporations that implement ESG principles, and the other are investor studies focused on investment funds that use ESG as part of their either selection or voting criteria. And they found a huge mix of things, right? So the sort of ESG glass half full people point to this and they say, well, this is great. 60% of studies of corporations found that companies that did ESG had better performance than companies that didn't implement ESG. Well, they look at that, they say it's a win. Well, this isn't a majority rules vote, right? Before you start making mass policy, you want to see something that's a little bit more unambiguous than that, right? So the rest of them found neutral, mixed, or negative. The investor, it's even less, right? 38% found positive, but the rest of them found neutral, mixed, or negative. And so there's also, I think, potentially a problem with publication bias. Just like the investment world, the scholarly world has gotten very obsessed with ESG these days. And so I'm not sure that we can view the journals as being completely unbiased on these points either. But nonetheless, these are the results that they are. I think the biggest problem is that flows could affect performance here. And also that it's just very, very mixed evidence. Here's some work that I've done on private markets. It's even harder to go and look at private fund performance. There's a lot of private equity that's motivated by social responsible investing, ESG, and so on. The TPG, Tax Pacific Group, used to be like an all-out shareholder value maximization shop. Now there's the Rise Fund, and they're doing all these things that are, supposedly stakeholder value maximizing. Although it might be that they just separated their companies out into two groups they would invest in anyway. We don't know. But what our results find is that when you look at performance of institutional investors in private equity asset class, you often find, it's a long-standing finding, that public pension funds tend to underperform. And we did a study of investments in infrastructure, just one asset class. We're able to dig pretty deeply in there. And we find that a good chunk, 30% of their underperformance in the asset class, can be linked to ESG regulations and ESG preferences, including investment in impact funds and investment in UNPRI signatories. So private markets, some evidence there as well. Charlie Munger, vice chair of Berkshire Hathaway, had the following reaction. He said, I think the world of BlackRock CEO Larry Fink but I'm not sure I want him to be my emperor. Well, what did he mean? What did he mean by that? And this gets to this accountability question. Is when Larry Fink says these things that we're doing, stakeholder, being attentive to stakeholders is going to create long-term shareholder value, and trust me, I know what I'm doing, and trust me, I know what you want. Well, it might not be the case that he knows what everybody wants. And this is particularly a problem in index funds, where BlackRock features prominently among the big three in index funds, the other two being Vanguard and State Street, and then there's some others, Fidelity. But around half of all equity funds are index funds, passive, or basically passive capital. And these big three companies are the plurality. So if you add up the shares that they have in each S&P 500 firm, in 88% of those firms, these three funds are going to be the plurality. And what is their incentive here? Well, these are index funds, so they're not necessarily going to be voting in ways that are going to be maximizing shareholder value firm by firm. These index funds make money by marketing their tracking of an index. So in a sense, there isn't really a discipline to see whether what they're doing, how they're voting, is actually maximizing shareholder value. So the result is that you have a very serious principal agent problem. And so it leads to serious questions for accountability. Question number one, is ESG financially material in a positive way? And I think we've seen the evidence is extremely mixed. You can't say that ESG is necessarily financially material in a positive way. It might be positive, it might be negative, we don't know. And making a claim that it is always positive and that paying attention to stakeholders instead of shareholders is always going to be shareholder value maximizing, that's just, I mean, I'm sorry, I actually think that's a fraudulent claim. So if it's not financially material, the question is it what investors want? Is anyone asking that? People ask the Fidelity or the Schroders defined contribution plan clients whether they thought that ESG would outperform non-ESG funds, and most of them said yes. It turns out they're doing that, I think, on a not very sound basis. If it's a trade-off, if there's a concession, if you have to actually sacrifice shareholder value in order to pursue stakeholder interests, is it actually what investors want? Is anyone asking them? I think that's the big problem, and that's what Charlie Munger meant when he said, I don't want Larry Fink to be his emperor. The point is that if Larry Fink is going to invest on my behalf or on your behalf or on your behalf, and he's going to make decisions that are not 100% motivated by maximizing shareholder value, how does he know that that's what it is that you want him to do? Did he ask you? I don't think so. And if he asked, he would find that there's a tremendous heterogeneity of views among all of his shareholders. And yet he's going to say, okay, I'm going to do one thing. And I'm going to give you one last example of why I think this accountability is a real problem. You can go through Gallup polls on topics like energy. And here's a topic, I mean, there are many of these that might surprise you. Maybe in Texas it doesn't surprise you, but in California this surprised a lot of people. Okay, so they asked respondents, they do this every 2 years. So I'm really excited for the 2023 data because it's 2021. Do you favor dramatically reducing fossil fuel use to curtail greenhouse gas emissions? 60% of people said yes to that question. Then they start drilling down and asking, okay, what sources of domestic energy production do you think we should curtail? So the first one they asked, do you favor reducing emphasis on coal as a source of domestic energy? So then it went down to 49%. I guess the other 11%, live in West Virginia or coal miners, right? So okay, because of the fossil fuels, coal is the one that produces the most greenhouse gas emissions per unit of energy produced. But oil, okay, do you favor reduced emphasis on oil as a source of domestic energy? 39%. Again, this is not Texas specific. This is the national sample. Okay, and then finally, do you favor reduced emphasis on natural gas as a source of domestic energy? Only 19% of Americans in a Gallup poll favor a reduced emphasis on natural gas as a source of domestic energy. And yet, any company that produces natural gas right now is getting dinged heavily in ESG ratings. In some cases, won't be touched by large segments of the public investment and private equity world because they are producing fossil fuels, natural gas included, right? And it wouldn't comfort these folks in any way to say, well, we're only producing natural gas. They're still going to be taking a hit on this. And so I think this shows that there's a real question of accountability. What do the American people actually want? Right? Again, 5% of households own stock, 52.5% of households own some shares. So unless that group of people is like extremely different from this group of people, which I don't think it is, there seems to be a mismatch if their investment managers are investing in this way. So I'm going to just, my last slide is conclusion, then I'm going for questions. So conclusion. So first of all, the words of Milton Friedman, there is no free lunch. The shareholder and stakeholder models are often in conflict. They are sometimes maybe aligned, but they are often in conflict. And claiming that they're not in conflict or not ever in conflict is probably disingenuous, perhaps fraudulent, and in any case, incorrect. All investment management involves a principal-agent relationship. Managers are managing money on behalf of other people. And the baseline, when I think of the baseline of shareholder capitalism, it's not necessarily one where the manager is always only maximizing shareholder value to the exclusion of all their considerations. It is, number one, as Milton Friedman already said, taking legal and ethical considerations into consideration, but also it may be that the interests of the owners of the company could be not only shareholder value maximization. And if that's the case, then the managers of the company owe a duty to the shareholders to do with the company what it is that the shareholders want. However, to protect investors, there's got to be a high bar for any deviations from clear shareholder value maximization. Otherwise, the managers of the money can just go and claim that I'm investing, I'm voting in certain ways in these proxy contests that are going to be they're going to promote ESG goals without actually checking or confirming with people what it is that they actually want. And I think the biggest problem is indeed investment managers voting in ways that their actual shareholder clients would not approve of if asked. And so in terms of a regulatory conclusion, I think that the SEC, at least maybe not in this current incarnation of it, but perhaps a future incarnation of the SEC, would hopefully pay attention to the idea that their main role has traditionally been to protect individual investors. And as such, their regulation should be making sure that money managers aren't assuming that clients agree with the pursuit of non-financial motives when making voting decisions and investment decisions. So those are my remarks, and we can now turn it over to questions. I think, okay. So let's go here and then here. Yeah.
Because a lot of these households are people like me who just give up the funds to the investment manager, you do with it what you want. And then they don't really know what's in my mind. They're just assuming on my behalf. But what I'm struggling to understand is there is a difference because whether they're following a shareholder model or a stakeholder model, I don't know what they're doing and I'm not bothering to find out. But where is that difference when it comes to the two models?
So I think the question is, will the money manager on your behalf follow a shareholder value maximization approach, which is we're going to only vote when we vote on corporate matters, we're only going to vote in ways that maximize shareholder value. And also when we select companies, we're only going to select based on the maximization of shareholder value. We're not going to consider other things. The stakeholder model would be if they're going to consider these other factors. So the I think the idea that I'm sort of putting forth here is the presumption has to be when you invest money with them, the presumption is you want them to maximize the value, the risk-adjusted return on your investment, while also conforming to the laws. You don't want them to break the laws, and you don't want them to be unethical. But that beyond that, other things that they do might not be what it is that their clients want. And so I think it goes to the question of what is the presumptive role. And I think the presumptive role of the money manager is to maximize risk-adjusted returns for you. Is that kind of where you were going?
Sure, but then isn't it possible to just ask the people, like when they're signing up with money managers, they can just say, I don't want to do ESG investing, versus you can do ESG investing. If they ask me, I'd say, sure, go ahead with ESG investing.
Yeah.
I'd be fine with that.
Yep.
But like, does it really matter if I hear about oil or coal or fossil? You know what? Like, because again, like I could also have I don't have these very specific preferences. is what I'm saying.
Yes. So if you don't have very specific preferences, but you favor ESG, then you can buy an ESG fund. And then you're giving your money to them and you're saying, whatever you say ESG is, you go for it. I'm willing to let you be the person who's deciding. And ESG funds are very popular these days. And so that's, those people are making that same decision that you are. What's more concerning is when you have index funds, which are there to just track the index and represent a very, very wide range of people, not people who've necessarily selected in to non-financial investing. And then I think the SEC should be worried about the idea that money managers might well be investing with other objectives in mind, even though the presumptive reason that I invest in an index fund is just because I want the investor to do a risk-adjusted, maximized expected return on my investment. So, so I guess breaking into ultimately maybe we will end up breaking into clienteles. And Vivek Ramaswamy has a new firm, Strive Capital Management, which is he says I'm the non-ESG investment firm. If you want to maximize shareholder value, invest with me. And so that's going to attract capital from one group of people. Others who want ESG or are willing to delegate, don't have really strong preferences, can delegate them by investing in ESG funds. I think it's where we, in terms of investor protection, I guess we want to make sure that where possible, that the agent is not doing things the principal would not want without the principal knowing about it.
And just to follow up with this question with the notion that, this suggests that somehow, competition take care of it. And that's problematic, right? Because competition won't take care of it. The SEC now says, no, you ought to be paying attention to this and that when making decisions.
All the SEC is saying is you have to disclose it, right?
For now, but that tips the hand. I mean, I guess that's like giving a signal to the people managing those funds that, well, I better not be scoring badly on those things. I don't know. That's again, it's not just a purely competitive space.
Right.
We expect the competition to take care of it.
Well, once the government gets involved in regulating what gets disclosed beyond things that would be financially material, then you're in a space where they are, I think you would think they would in effect be guiding investment managers, in certain directions, and whether that's what the people who are investing the money actually want, or their principles is a separate question.
But isn't that a little bit circular? You're saying fund managers should make a presumption that financially material considerations are all that their investors want.
Yep.
And you're also saying the SEC shouldn't require disclosure of anything but financially material considerations. So if there's only financially material information out there and there's not ESG information out there, then the investor who wants to invest ESG doesn't have the same level of information to help them in a competitive market as the investor who doesn't want ESG.
Well, why would a competitive market not lead to the disclosure of exactly what the investors want? If the investors want disclosures about carbon emissions, they can get disclosures about carbon emissions by asking the company. If enough investors want it, there'll be a vote for it, and then there will be the disclosure of what it is that the investors are looking for. If the government has to come in and say, we think you should disclose this, this, and this, then it's imposing costs on the company, and it's not, it's not clear. So I think that the most benign interpretation is it's just a disclosure cost, and investors can ignore it if they want to. But it could also be what you're saying, which is that it's sort of telling investment managers they need to pay attention. It could also signal, and this is the other thing you hear, another way that a stakeholder and shareholder become aligned is if this is a signal of what type of future regulation is coming down the pike if companies don't actually, do the things, minimize the carbon emissions, right? Is part of this disclosure so that we, the government, can then identify, who are the bad agents, and then we can regulate you, and that's going to align these two things pretty quickly.
So two-parter. First part, would you be in favor of a rule that says that mutual funds that are just designed to track an index can't vote their shares on behalf of the actual holders of those equities? So I'm curious about your answer to that. And two, the direction this conversation is going is very reminiscent to a period a long time ago when we wondered if we should mandate even financial disclosures, or whether we should mandate the auditing of those financial disclosures. And it seems like the argument's being made now that the government, there's no need for the government to step in to mandate disclosure of whatever, whether it's ESG or something else, could be sort of locked back all the way to, well, shareholders can just ask their companies to disclose earnings. Why don't we just leave it to the market to do that as well?
Okay, good. So, so on the first one, your proposal is a rule that index funds just shouldn't vote at all, right?
Sure.
Well, I mean, you're in it, yeah, so you are in a situation there where index funds own so much of the market.
Well, I own it, right? They own it.
Yeah, well, that's right. You own it through index funds. I guess I would contrast that idea with the idea that index funds should be voting to maximize shareholder value. And if not, then they need the permission of their investors to do so, and that there would be multiple types of index funds. And there would be sort of more ESG focused index funds, and there would be index funds that are always going to vote for shareholder value. So I prefer there to be a clarification than just saying we're going to have all this 100% passive capital. As for your other point, right, which is, okay, now we're talking about, you can go back, you could say, okay, there's no, why should we ever require the companies to disclose anything if shareholders will just desire? Well, I just think, the presumption of investing is that investing is about financial return. And I just think that's the baseline. I think by saying, okay, now we're going to require disclosure of all this other stuff, it's shifting the baseline. And I just think there's a much higher standard for doing that, especially when there's agreement about what maximizing return means. I mean, you can look at a financial return, you can see what it is. With ESG, with investing for society, look, Texas's society is different from California's society. Take the average person from each of these places. How are you ever going to reconcile that? And how could the government actually be able to do that in a politically neutral way? I don't see it.
And even if you want to compare things like disclosing carbon emissions, you can say, oh, maybe you can make a story about some sort of risk associated with that. Again, mostly it's hard to do, but one could at least make that versus like racial composition of a board. That's a completely outrageous that the government mandated and to have anything to do with financial forms, right? And that's the kind of stuff that gets pushed through, not just from the West, but another place. So, right,
yeah, I mean, your point is that carbon emissions is a more sort of directly observable.
Potentially.
Although the question,
but that was some kind of risk.
How far down the supply chain do you want to go? Right? If I'm a restaurant, right? I mean, okay, it's not only what I cook with, but what ingredients I buy, how those ingredients are grown. How far down that chain are we going to go? But I agree with you. It is more directly observable, say, than some other things. It's still, though, as you pointed out, it suggests to investment managers and to people what they should care about. And some people might think there's a role for government to do that. I'm not so sure. And again, when you look at the vastly heterogeneous views of people, again, you can go back to this, right? I mean, it's like, okay, is the point then that now, the SEC is just going to try to convince these people sort of slowly that they're wrong? I mean, to me, it's worrisome to have the government doing that when there isn't this, super objective cut and dry thing. Yeah.
You said one of the problems with ESG is, I guess, definition wrong. What exactly is it? I mean, you mentioned carbon emissions, which is probably one of the more definable aspects. Do you think this is ever going to get to a point where it's definable in a manner that can be properly regulated? I mean, do you see that happening, or do you think it's going to go away before people will see the reality of it before that happens? I know that's a general question.
Well, I guess I see one or two paths, right? So the path we're currently on is one where there's ever-increasing government attempt to define ESG and to define the disclosures, to require the disclosures, and for it to be government imposed. If that happens, there will also be people who will be conducting thousands more studies on how ESG ratings on this, government-derived rating system correlates with performance. And at some point, there will probably be a reckoning the question as to whether ESG and financial performance are really actually truly positively correlated or not. And maybe 78% of people won't anymore think that the two things go together. So I guess I think that if we do go in that direction, I think it's kind of a fragile thing, and that it might be that you get some really strong adherence to it, but it might be that the reality of financial returns, which I actually personally believe will be negatively correlated with that government-imposed ESG rating, would shake some people away from that, and that there would then sort of be a backlash. Of course, the other direction we go in, I mean, the direction I keep hoping we're going to go in is my last bullet point, which is that for some reason maybe the SEC might wake up and remember that what it really needs to be doing is protecting individuals from money managers doing things with their money that they don't want the money manager to be doing. In which case we would hopefully go in a different direction. But that's not the direction that the SEC is going at the present time. Yeah, Sam.
How do you think about acceptable ethical considerations? So the Friedman is subject to not just the law, but ethical considerations. I think you could broadly think about stakeholder capitalism and ESG as a form of ethical considerations. It's difficult for me to know where to draw a bright line. You have kind of messier disagreements about what the ethics are. It's kind of harder to monitor than I think what Friedman had in mind, but I'm not sure where to actually draw that line.
Right. Well, I think when Friedman said that, I think he was essentially giving support to the basic idea of a business judgment rule. That in effect he wanted people to be able to bring some ethical non-financial consideration in there. But you're right, it's always going to be something that is somewhat subjective. And the way that I see it is that it is up to the shareholders of the company. Different people have different ethical standards. Shareholders of the company are the ones who are going to determine to what how far the company goes to maximize shareholder value. Potentially running up against certain ethical considerations. And if something is really unethical, then my question is, well, why is it not illegal? It's like, and I think that sort of goes back to this whole thing, right? I mean, many people out there will tell you that it's totally unethical to invest in anything, any company that produces energy from natural gas. Well, then, if that's the case, why do we not have laws that are forbidding it? So I think look, if there's enough capital behind something, and for that business to succeed in a competitive environment, there are going to be different ethical considerations in different businesses, and I think that's just kind of the nature of capitalism, is that we have to live with some of that. So that's how I think about it. Yeah.
Of the ethical considerations, so going back to the second critique of shareholder capitalism, under this framework, companies are motivated to not have ethical consideration or being present in our society. So how, unless there are regulations, it's true that companies, what is compelling companies to take into account these considerations unless there are regulations? So how do you get companies to take ethical considerations into account without big government?
Interesting. I mean, I think if the process of passing laws and regulations, is allowing companies to do things in large scale that are highly unethical, then I think one has to ask, why is that? And I guess I'm not so convinced that our current system is highly permissive of highly unethical things. But maybe there are examples where that's the case. I think it's I wouldn't think it's the role of government to try to induce economic agents to do things that are or to induce them not to do things that are legal but undesirable in some way. Do you want to follow up?
Yeah, I should also point out that what's really frustrating about this discussion is that people that are concerned about the Gordon Gekko version of capitalism, we have that villain
as the person that represents capitalism. They're saying, you know what we need? We need the financial firms that are populated by voting mechanisms to inform the standards of ethics that we have to live by. Because they're the ones in charge of deciding what counts as ESG or not. You know, it's a better thing.
Right.
It's like, oh, so you're putting voting backward in charge of the voting ethics standards? I mean, it just seems completely circulating, completely bonkers in my mind.
Yes.
But
Yes.
that's where we are right now.
Yeah.
The voting backward is defining the standards of whatever ethics is.
Yeah, and then I would also just add that, like, again, there's nothing in anything that I've said that is at all against people investing for their ethical beliefs. You know, there's nothing against clientele forming. You have some companies that are going to be doing things that are consistent with one set of individuals, group of individuals, group of ethics, and another with another. And that's probably where we're going, is that, you know, competitive markets will lead to that type of segmentation. So yeah.
So the energy example is great. There's some issues in the ESG space that you would get like 80–90% agreement, especially around workers and wages.
Mm-hmm.
So what do you think the mechanism design should be for large scale shareholder input on those work decisions?
What should the mechanism be? Well, I mean, so I guess, first of all, one response, so, you know, BlackRock has not been totally unresponsive to some of these criticisms, and they have said, we're going to start surveying our largest investors on what it is that they want. So that would be one thing. And I think we are headed towards something where probably, you know, for say index fund investors, I mean, there needs to be at least some kind of general survey of, okay, do you want me to, you know, money manager has to ask the individual. I mean, just some questions. You want me to always maximize shareholder value, or which of these considerations do you want me to take into account? And I guess I think that hopefully somebody could design good surveys where the kind of you know, sort of space spanned by these questions would be enough to be able to give the money manager some guidance.
Well, one idea that I heard some discussion on is that trying to empower people to have their votes back and to provide competitive competition in who advisor votes. So I could be Team Red whenever I sign into my bank card account. I'm Team Red. Always maximize my cash. Do not have to put anything else, right? Just the cash. Versus Team Blue, which is going to be doing all sorts of labels and stuff up there. Fine. You vote in the beginning. You know, the country's half and half right now, so most people get to vote. You know, and my guess that Team Red will get a lot more votes. And that if you have advisors, they're now taking care of those votes and going through the proxy votes and say, okay, this is approximately 91 to yes versus one that's no. Wait, how difficult would that be for me to be empowered to make a choice when I vote my index fund to say I want to vote with Team Red, not Team Blue?
Would you tell your index fund, always maximize shareholder value, because it's hard to know what that means exactly?
No, always go to Team Red.
Always do what this person tells you to do.
Yeah,
Institutional, there aren't
those
And I trust them to do
Yeah,
it.
and then it's competition in that market. So they have to show you all that, and I vote based on that. Like, I want to buy that advice that these guys can, because
in
they're.
reference to your earlier question, I think actually Vanguard wants to get out of
Yeah,
this
they wanna get out of it.
they're like saying, if you want to vote your shares, we will let you do that. We do not want to do this bill.
It's very hard to do.
Yeah.
You can do it in your shares, but like not in the index fund.
Yeah, so formation of clienteles among these proxy advisory firms would be a direction that would, you know, resolve some of this.
Because that would be like something that, how can the SEC be opposed to the notion that you're empowering the owners to be able to vote on? I mean, it's just like it's completely simple.
Yes.
It is easy to implement. It's not, you know, there's some mechanical thing you need to develop, but it's not that hard.
It's asking a lot of individual shareholders to get the masses to balance.
No, but if you make like your advisor, that's not, again, big red or blue. Because that's gonna be the equilibrium thing. You're gonna have
Well, they actually do one.
I mean, there'll be 7 to 8 advisors, and
Right.
one of them's gonna be there, red meat, like money, and everyone's gonna be like, wow, this guy's help. Cool.
Yeah, John.
So on that note, you know, back in the 80s, when we were also worried that managers were not going to maximize shareholder value, it was a different business.
Yeah.
We thought they were going to be lazy. You know, we had this idea that the market for corporate control, you know, corporate raiders,
Right.
Ricardo Icahn, and people like that would come in and give activist investors say, how much do you think we can rely on that same dynamic? Keeping firms, if we really do think that ESG and stakeholder concerns are not going to be good for shareholders, these guys coming in and actually disciplining managers like they did in the 80s to maximize shareholder value.
Well, what I find fascinating is that some of the same individuals who used to be the pure shareholder value maximizing enforcers have now switched to becoming ESG enforcers. So I mean, one example is Jeff Ubben of Value Act Capital. I mean, this guy was, you know, the person that the CEO on the golf course was trembling that, you know, when the phone rang, it might be Jeff Ubben calling, telling him to stop playing golf. You know, I own 2% of your shares, stop playing golf and get the hell back to the office. But now Jeff Ubben's his whole philosophy has completely changed to be basically a pro ESG activist. So the market now, maybe that's because that's where he sees the new market opportunity for him is in that area. But I think, you know, I guess I would hope that to the extent that the market remains relatively free and open for these clienteles to be able to form, that you would have these formations of these clienteles that are shareholder value focused. You have other clienteles that are more ESG focused. Yeah, there's going to be competition. They're going to be competing against each other, and you know, the outcome of that competition is going to determine what we get from each of the companies. So I guess my point is that, yeah, you know, that mechanism will work to some extent to promote shareholder value maximization, but they're going to be competing clienteles who are going to want other things. And it'll, you know, what equilibrium we arrive at with you know, with each company, I think is really a question.
So is there any evidence that this, again, a company can finance itself with debt or equity? Is there any evidence that the more you murk the signal from equity, investor might say, you know what, I want to engage in activity with these things, I want to finance, I want to put my money somewhere, but I'm going to go through that versus equity. Is that any sort of indication that has a potential for it to be like, wow, you know, I want to play those games. So as if you're on a bond, and that's something that, you know, I have preference on whenever things go wrong. And yeah, I know that I'm not going to get the upside, but
and the market for those bonds, you're saying that the more market or the more return oriented people are going to prefer to buy bonds, and then the more, is that how you see it?
Yeah, I'm thinking that it's going to be more secure, from my perspective, to go into the bond side, because it's going to be something that is a more direct transaction that doesn't involve, you know, the sort of like what would have been the upside. Because in equity, what's happening, let's say you grow, you're still going to be a good company, but it would have been better if you didn't have, you know, so we have these counterfactors really hard to measure. Then becomes you know, we might all of our index would be underperforming because they're engaging these things that are not challenging.
That's the challenge.
And there's no way for us to measure that right now.
Yeah.
Well, you're not subject to a black, right?
That's right.
You're signing a debt contract.
It's a clearer contract with fewer issues of. I don't know.
If there's a general loss of faith in equity markets, then I think you would see that shift. I mean, you have the supply and demand for different types of capital. You would then see that. I don't know if we're there yet, but
corporate bonds are sort of a better calculation than equity.
Yeah.
So it's like, you know, there's actually like a reason.
Depends on time period.
Yeah, that's right.
Carlos's point about voting shares and multiple proxy advisors. I actually did a big report on this for work during the latter part of last year, and unfortunately, Team Red doesn't really exist at the moment.
We need to make it,
They don't. There are two firms in this market. One's called ISS, the other one's called Glass Lewis. They control like something like over 97% of I've investigated who their actual employees are. Right? But yeah, that is it. Going back to the quote you had from Larry Fink about stakeholder capitalism, and what I wrote down somewhat tongue-in-cheek but also completely serious is, isn't someone like Larry Fink claiming to be super selfless a gigantic red flag that he's acting selfishly? And my broader, placing that within like a broader framework, to what degree is all of this ESG stuff just a gigantic ruse to create a barrier to entry and give preferential treatment to the biggest players already in the market?
Well, on the first one, I mean, you know, I guess I always assumed that everyone's actions are self-motivated. I mean, it's basically honest assumption. I mean, never generally, particularly people in the investment world, never really acting in truly altruistic ways. And as for just consolidating power with the big players, possibly, although at the same time, it seems like, there's a lot at stake now for these guys. Look, Texas has now passed SB 13, which is it's basically a boycott law for companies that engage in lots of ESG. I think it's the Attorney General who's responsible for creating the list in Texas. The comptroller is responsible for creating the list. There's some non-trivial money that's going to be lost by these by some of these investment firms.
A bank that just went under this week in Switzerland was banned from our list to do state visits.
Okay, well, thank you, comptroller. It wasn't banned for that reason, but and so I think that may have been their play, but it might backfire. And I should note while we're talking about state regulation, I think I read that in recent months there's been a bit of a backlash against these boycott type approaches by state legislatures. Not only Texas, but I think 17 other states have these kind of boycott types of approaches. And the problem is that if taken to a logical conclusion, it precludes investing in like the vast majority of very established investment firms, including private equity firms. So, for example, Indiana had a proposal that kind of mimics SB 17. The Indiana public pension system put out a report saying this is going to cost us $7 billion. Well, I dug into where that came from, and where it came from was they're assuming that their private equity investments return more than their public equity investments, and they argued that this legislation was effectively going to rule out any investment in private equity because all the private equity firms would be boycotted under the rule. I think some other states and smaller states have actually kind of gone into reverse on some of this boycotting. But the other method is the Rauh and Florida approach, which is to say that the retirement systems, state investment funds are not allowed to use ESG considerations in investing. And so that's a bit more of a targeted thing, right? That doesn't say you can never invest with BlackRock. It just says that, if BlackRock is doing ESG, you can't invest in that product or whatever. There might be they need to demonstrate that they're not doing ESG.
Does the Texas approach pull us back off that efficient frontier you were talking about with exclusionary ESG funds, just in the other direction?
That would be saying that the boycotting is removing the ability to get access to certain investments, in various space. I don't know if it does that. There is a paper that says that it increases things like municipal borrowing costs because when cities or the state want to issue bonds, they have to get an underwriter to do it, and now you can't use any of the underwriters because they're all smoking too much ESG.
But let's be clear. The Texas law is like if a financial institution discriminate against the Texas business. So, for example, if a financial institution says to an oil company, "I'm not going to finance you, not because your numbers are bad, but because you drove oil," and that's shown, then that firm cannot do business with the state. Right, so I cannot bank with the state.
Being off the efficient frontier more than
Right, the state cannot bank, but again, there's still enough companies that the state can bank. The problem, I guess, would be not an investment thing, it's more like a state cannot bank. So the new law that's being considered now is more in line with the notion of, the Senate's notion of no pension fund in Texas, any of the state funds can do any investment with ESG considerations. Not banning the firm, just saying that you shall really look at that. Basically, the untitled Biden deal today.
In fact, I think in Texas, the colloquial statement of Texas law is, if you boycott us, we're going to boycott you. Right? That's it. And that's more in the banking, in the sort of banking institution.
So, public versus private markets. I think if we go back to the same question of the ethical consideration, right? It's something that we can all disagree what's not, and there'll be different standards and so on. And we have a pretty clear mechanism for that those things to be enforced through the private market. So a company in the private market, you don't go sell your shares elsewhere, just your investors, they come in, they decide to be okay with your standards, and that's fine. But then we created this thing called public markets, which is very overrized, really hard to keep track of things, you're not even paying attention, so on and so forth. And then we had a bunch of rules to put in place to make sure that those markets were very transparent on the financial side of things, making sure that you because it's impossible to keep track of, right? It seems that it's obvious what needs to take place here to some degree. Like, leave the public markets alone. Public markets about, I think even Friedman was not really okay with the notion that ethical standards should be put in the public market. Even him would probably not be happy with the way that we have a lot of leeway in the SEC when you submit your perspective, whatever, for a public fund for offering, right? You can say a lot of things. You can decide to be pro this, that, the other. And I think that to me is a very clear separation between, like, if you want to do things outside of just making people money, do it privately. What's wrong with that, right? There's still mechanisms for you to invest in that and so on, but don't go to a market that is protected by, a system that's easy, that should be government protected and so on. I don't know, it's just something that.
Well, I guess again, it goes to this idea that in public markets, the presumption if you buy security is that you're looking for
just looking to make money.
Yeah, you're looking to make money. That's the presumption. And if we follow that to its logical conclusion, it would say, that public markets should be primarily about natural value maximization. I agree.
There's a vehicle, what drives me nuts is that there's a vehicle for that.
Yeah.
Go do your thing over here.
Yeah.
Don't come to me, to my turf, and say, no, you ought to do as well. Right? That's what really good.
And there's a huge private market for all of this. And there are huge funds that are that have been assembled, huge private equity funds that are all about all kinds of other objectives. And so fine, let that happen.
I think we do want a lot of these firms in the public markets. I mean, getting back to the mean variance frontier, the more firms that you have in the
No, I agree with that.
markets, the more efficient.
I agree with that. But insofar that these firms are making decisions that I think are reducing their ability to generate profit, then private. I don't want them in my short steps. But
I hear you guys agree, and I hear you being very nice, but I see a huge distinction to what you're both saying. I hear you as saying, give the owners the choice, and I hear you as saying, restrict choices from the owners. Saying, like, you cannot do ESG, even if shareholders demand it.
yes, I would say that the public markets would prefer that you cannot. It should be only about profit maximization.
Okay,
that'll be, I guess,
Okay, that is, I guess I feel somewhat different about it. I guess I think that the, what I say is that the presumption in public markets should be that you're doing shareholder value maximization. But I guess, I'm not sure I see why you would have to completely ban the idea of a publicly traded company that's very, very open about the idea that it's not going to maximize shareholder value. I mean, why? I mean, people want to buy that stock because they want to feel good, then they can do that. And
It's the legal infrastructure now that are prohibited from that. The legal infrastructure is thinking of fiduciary duty to pursue shareholder.
What if there's a shareholder vote?
Subject to like there's a business judgment rule that maybe you can, there'll never be.
They have a lot of leeway with that. They have a lot of leeway with that. They can say their perspectives like they are, perhaps in disagreement with that.
They have enough leeway, I mean, right, or at very least they can just claim that it's all consistent with long-term value.
That's right, but the legal responsibility is to pursue the shareholder.
Right. I don't disagree. And it's hard for me to sit here and say, oh, no, I don't like the idea that if I say what I'm doing and you want to buy my share, you should be able to do it. That's obviously something that we should be okay with.
Yeah.
But the system is such that, when my mom buys some stock, she's not buying a direct company. She's buying through a mutual fund, most likely through an index fund. And there's no way in hell can expect her to ever have the ability to, go through 500 companies and, this, that, and the other. So I think that's why the presumption has to be done. No, in that market where so much is going to be either passive or through, very broad diversified portfolios, that should be about profit maximization.
Yeah, and I think that's where, where Vivek's desire to reform the business judgment rule comes from, is to be able to say, look, these companies can't just be claiming that they're doing things for shareholder value maximization when in fact they're not. And it seems to me that the public has been largely misled by this. I mean, the fact that 78% of people think that ESG, and this is one story, I think that, ESG stocks are going to outperform non-ESG stocks. I mean, that just says to me, that just, they've been misinformed, and they're believing what might be being sold to them by Larry Fink for his own purposes. I mean, it's really that's really a problem.
And I actually,
I had a suggestion about empirics that might relate to some of this. You showed us some, well, there it is right there, the data about what do people think about coal, oil, gas, and so on. What if you asked a question that said something like, how much of a percent on financial returns would you be able to give up in order to serve stakeholder interests rather than, pure financial return? Is there any data?
There is at least one study out there. Steve, my colleague, political science colleague, Steve Haber, has done some work on that. And, but it's sort of in dollar terms. It's kind of like people are willing to give up, $50 for this or that. And I do think, we have to understand, how much percent return people are willing to actually sacrifice for any one of these goals.
Well, that could be theoretically important because you would expect, if your assumption is that the whole financial enterprise is about maximizing return, you would expect the number to be 0 for most respondents. So if you found, some number of respondents that say greater than 0 is the loss I'm willing to take for the stakeholder objectives, then that would inform, some of these assumptions we're making about what sorts of information are relevant to investors, what sorts of information the government should try to ensure are provided to investors before they invest, and that kind of thing.
Well, I think there are a non-trivial number of people, particularly younger people, who really like the idea of investing for society and are willing, at least, avow that they're willing to forego returns in exchange for that. I think you are actually going to find that. That's something to grapple with, and I guess we have to give these people securities to invest in. I'd like securities to invest in that are going to maximize shareholder value, and so I think that's where we're going to have our clientele formation, and we need a system that's going to be sort of robust to both of those things, without people being misled into thinking they're getting one but not the other, or people who think they're getting both at the same time. I mean, and I think there are going to have to be some regulatory reforms probably against it.
I wanted to reconcile the two views. I wonder if having actually a completely non-existence of an SEC, for example, would do that. Because that would be a truly competitive market now, where people have to, convince me that that's the place, as opposed to me assuming that I'm going into a mutual fund, and that's this presumption that somehow the government is making sure this thing is built in a particular way and so on. And then, you take away the ability for any kind of enforcement to be done through this vehicle, regulatory vehicles, as opposed to just like the two competitors. But again, I dream of a world without an SEC.
Yeah.
I understand it's not.
Right. Well, I guess maybe I guess I have actually, I tend to be, my first reaction is to be generally a kind of anti-regulation reaction. But I feel like where we've gotten to now is a place where, without some actual measures by the SEC or by regulators, individuals are getting ripped off. And there's been this back and forth. The Trump administration, Department of Labor passed some laws. This is about retirement plans and clarifying that essentially you had to pursue, as a fiduciary and under ERISA, you had to pursue shareholder value maximization. The Biden administration tried to walk that back into rules, and then Congress had a proposed law that would basically restore the Trump administration, even I understand.
Bipartisan law.
Bipartisan law, and I hear that was just vetoed today by Biden. So there's a big back and forth going on there. In the meantime, I suspect, especially because there's so much action going on in this index fund space, we have no, you pointed out, we have no real way of measuring what the overall impact has been of voting in ways that might not be in favor of shareholder value maximization. Where all we're left with is Larry Fink's claim that these things are perfectly aligned, and there's just no basis for that.
When you talk about shareholder maximization of value, what time period are you talking about? Like a quarter, a year, 5 years? That seems to get a little bit lost for me in the discussion.
Well, I guess, I think as a finance professor, my view is that the differences between short-term and long-term value maximization are just not really that great. I mean, the present value of expected future cash flows today is the same as the expected value of the share price in 2 years plus the expected future cash flows after 2 years. And so I think I just, unless you can prove show me evidence that markets are like really fooled in in the short term, and not that new information comes out, because just because, it's not enough to just say that, oh, well, Silicon Valley Bank failed, and, people didn't think it was gonna fail, or it had a market cap, or whatever. To really show that markets are excessively short term, or are, overweighting short-term considerations relative to the long term, I think it's just tough to show. So I guess, I don't see there as being that much of a disconnect in those things.
All right, thank you, Josh.